let's introduce Stuart McDonald, the president of Taseko Mines, who's calling in from the west coast of Canada. I'm sure their internet is fantastic and won't go wrong at all. But if it does, then bear with us, and I will waffle to fill any gaps. Stuart, over to you.
Okay, thank you very much, Paul. Yeah, thanks for hosting today, and I'm just going to share my screen here. Yeah, thanks to ShareSoc for hosting this event, and obviously, if I think 88% of our viewers are not Taseko investors, so that's a great opportunity for us to tell our story, and yeah, so we're excited to be here. Give you a quick introduction. I'm Stuart McDonald, the president of the company, and Taseko Mines, we're a Canadian-based copper miner. We're actually building a multi-asset copper producer, and we're focused on top mining jurisdictions in Western Canada and Arizona in the US. We've got at this stage one producing asset, which is the Gibraltar copper mine, and we have a portfolio of 4 major development projects. One of those, the Florence copper project, is probably the nearest term development, and it's going to become our second mine in the next couple of years. So we'll be moving to 2 operations. It's an exciting time for us. And then following behind Florence, we have 3 others, New Prosperity, Yellowhead, and Alley. Each of those are also identified mineral reserves, mineral deposits in British Columbia, and they're in various stages of permitting and feasibility as well. So we've got a strong portfolio. But really, most of this presentation today is focused on the 2 key assets, which are Gibraltar and Florence. So maybe just a couple of comments on our Gibraltar mine. As I mentioned, it's a large-scale mine. It's actually the 2nd largest open-pit copper mine in Canada, 4th largest in North America. It's a mine with a long history, actually originally built in the early 70s. So it's been running for over 40 years. And it's got a long mine life still remaining, with 17 years of identified reserves and potential to expand that as well through further drilling, through further exploration. So we've operated the mine continuously since 2004, where the current management team went through a restart. And after that restart, we made some major capital investments and built the mine into what it is today, which is a stable cash flow generator for us. And at the current copper prices, we generate very good cash flows at these levels, and we can talk about that in more detail. The growth of the project, or the growth of the company, is coming from our Florence development project in Arizona. This is a near-term, high-return copper project. We're currently anticipating to receive our final permit that we need in the 3rd quarter this year. And at that point, we'll have everything in place to commence construction. It's about an 18-month construction period, and so by early 2023, we'll be into commercial scale production. At that point, it'll be a green source of US domestic mined copper, and it's got a very exciting and innovative production method there, which we can talk about. But you know, it's low cost. That's a key. Low capital cost, low operating cost, and low environmental impact. So we'll get into that in more detail. Our management team, we believe we're a proven team of mine builders and operators. What we've done at Gibraltar over the last 15 years, we think is quite an achievement in expanding and developing that operation and keeping our costs down. And we're taking that same expertise and those same principles to Florence and our other development projects. So we're a proven team. We've got a strong commitment to environmental management, social and governance performance. ESG, I guess, is an important factor in our business. And you know, at Gibraltar, we've really shown how to run a successful operation. It's an award-winning operation for health and safety. That's very important for us. Obviously, we're focused on copper, and a lot of our prospects are tied to the metal. We think the metal is, you know, there's very strong fundamentals for the metal right now. It's an exciting story with the shift towards electrification and the challenges that we have on the supply side. So we're happy to be in the copper metal, and we like the jurisdictions that we operate in. You know, BC and Arizona are both very low in terms of political risk, and you know, they're strong, established mining jurisdictions, and we don't face some of the jurisdictional risk that you see in other copper mines and other copper development projects around the world. So that we think is somewhat unique. So that's a quick overview, and maybe move on to just to talk about copper in more detail. You know, it's obviously been a dramatic change in the market over the last year. I think from the depths of the pandemic 15 months ago, where copper hit almost $2 a pound. You know, that had a big impact on us for a short period of time. But we saw then a very strong recovery through the remainder of 2020 and early into this year, with spot prices reaching well over $4.50 a pound. It's come off in the last week a little bit, but still on historical levels, we're at very high copper prices at the current time. And that's, as I said, it's really, in our view, driven by fundamentals. You know, you have very strong demand coming out of a recovery, an economic recovery in China. You have the market and the investors out there starting to see the importance of copper in our overall shift towards electrification of our economies. So this overall trend away from fossil fuels to electrification. You know, electricity requires copper. That's the primary use of copper, is as a conductor. And you know, that demand growth that story is very compelling over the next 10 years as we move to renewable energy and electric vehicles. There's also, you know, on the supply side of the equation, there are a lot of challenges. There haven't been many investments in new mines made over the last 10 years. And the mines that are out there have declining grades and declining production, which we expect to see trend downwards over the next 5 to 10 years. And there's not many new projects coming in the pipeline. It's very challenging to build, to bring on new capacity. You can't just turn on the taps in copper mine. There are long lead times to bring on a new mine. So that combination of growing demand and supply constraint over the next 5 to 10 years is very compelling, and that's why we see you know, such a bullish outlook in the market. So this is a picture of one of the pits at our Gibraltar copper mine. As I said, located in central BC. It's an open pit mine, as you can see, producing copper and a little bit of molybdenum byproduct. We'll produce here for another 17 years. Actually, this particular pit we just finished mining at the end of in Q4 last year. This is the granite pit where we mined approximately for 10 years or so to establish this pit. Now there's 5 pits on the property, so we're now transitioning into the Pollyanna pit in the current year and the Gibraltar pit in future years. Yeah, so just a little bit of history. We acquired the mine in 1999. We restarted it in 2004. And as I said, in those initial years, between 2006 and 2013, we embarked on a major modernization and expansion period. I think our CEO at the time had quite a vision for the operation and realized that, you know, in order for this to be a long life mine, you know, we really needed to expand our mill throughput and get our unit costs down. And, you know, running more tons through the mill, spreading our fixed costs over more tons and more pounds of copper was really the thesis. And I think, you know, that investment, we invested over $800 million over 7 years, has really proven itself to be a wise move, because really since about 2013, you know, we've generated positive cash flow every year, and that's through some real ups and downs in the copper price. So we've shown that the mine will generate stable cash flows at any reasonable copper price, and that's important, right? Because we know we're in a cyclical business, and copper prices are high and they can drop as well at times. So we've got a proven operation here that's going to operate through the price cycle and be a good solid cash flow generator for us. It's a well-run operation. We're an industry leader in terms of health and safety in the province of BC. We've won the John Ash Safety Award for I think 5 out of the last 7 years. We've won that award for the lowest injury frequency rate. And I think a safe mine is typically a well-managed and well-run, efficient operation, and that's what we think we have here at Gibraltar. If we look at our costs, and maybe just before we talk about costs, I guess grade. A lot of people, when they look at a copper mine, they ask, what's the grade of your ore? We're at Gibraltar about a 0.25% copper grade. And on a global scale, that would be probably considered a lower grade mine. But the reason that we make that work is we're also one of the lowest cost open pit mines in the Americas. And when we talk about costs, I'm talking about cost for every ton of ore, cost per ton of ore that we put through the mill. So we can mill a ton of ore for about just over $8 US a ton. And that ranks very favorably against any of the big mines in the US or Chile or Peru. So how do we achieve that? I think it's through that skilled and productive workforce. We run this operation with 700 employees, and a comparable operation in South America may have 2,000 or 3,000. And their wages on the mine sites are similar or even higher now in Chile. So that's a big advantage we have. We also have access to excellent infrastructure in the center of BC. Low cost, reliable grid power from a hydroelectric source. We're right on the rail line, we're right on the highway. We have 2 nearby cities where our workforce can commute to work from. So all of these advantages make it a low cost and efficient operation, and we've been able to translate that into solid earnings over the last few years. I think last year we had over $100 million Canadian of adjusted EBITDA and operating cash flow. And that was with a much lower copper price than we see today. I think our average copper price last year was $2.80 a pound. Well, now we're well over $4 a pound. And you can see in the chart there the leverage that we have to higher copper prices. So at Gibraltar, we produce about 120 to 130 million pounds a year. We own 75% of that mine, so that's about 100 million attributable pounds to Taseko. And that's for every 10-cent move in the copper price, that's $10 million of $10 million US dollars of EBITDA. So yeah, in the chart, and then if we can make improvements to lower our unit costs as well, where we see a few opportunities, that can obviously drive improvements to the bottom line as well. But the leverage that we have is quite unique, and you can see the movements in our stock price as the copper price moves over the last year. Is a testament to that leverage. That's a big part of our investment thesis. So looking at the operation, we're just coming off 2 quarters of, I would say, lower grade production. We do have periods of time in the mine where we will cycle through grades that are slightly below average. So we're coming off 2 below average production quarters, but we've given guidance to the market that the second quarter, the Q2, will be slightly higher in terms of production. And then the second half of this year, we're expecting much stronger production as we cycle into higher grade ore zones. So for the year, we expect about 125 million pounds of copper, and that could generate well over $200 million of operating margin at these prices. So we're pretty excited about what's to come here, and we don't think that those margins or that the impact of that copper price is fully appreciated yet by the market, because we have had 2 weaker quarters. So we'll see. As I said, we'll see what happens over the remainder of the year. So that's Gibraltar, and now maybe I can move on to our second asset, which is our Florence copper project. This is really our future, and it's an exciting low-cost project. This is an overhead view of our well field, and you can see it's a very different view than what you saw at Gibraltar. This is in situ leaching. So what we're actually doing here is drilling a well field into the ore body, injecting solutions into the copper and recovering copper in solution. So there's very little environmental impact here, or very little surface disturbance. It's quite a unique and quite a low cost mining method. So we acquired the project in 2014, and again, it was a project even at that time that was well known, that had been well invested by previous owners in the 80s and 90s. Since about 2014, we've invested a further $80 million into the asset, and the principal thing that we've done over that period is actually build and operate a production test facility. And you can see the picture of that in the bottom right corner, the PTF as we call it. The purpose of this was to prove the feasibility of our production method here, and also demonstrate to the regulators that we could operate this mine in compliance. And that test facility has been very successful on both fronts, and we're now on the cusp of moving into construction and an expansion, essentially, into a commercial scale. So the economics of that commercial project are very attractive, as you can see on the slide. A $230 million capital investment is going to get us a 21-year mine life, where we can produce 85 million pounds a year of copper cathode, and do that at a very low operating cost of below at $1 a pound. So on a global basis, that's really a top tier mine in terms of cost and economics. And even at $3 copper prices, that's getting us close to a 40% IRR and a 2.5-year payback. So it's a very exciting project, and we think that with the technical work that we've done over the last 6 or 7 years, that we've really de-risked this and really ready to show the true value of it as we move into commercial operation. Here's a cross section, I guess, of what we're planning to do in terms of the mining method. You can see this is essentially what we do is a 5-spot pattern of injection and recovery wells. So where we inject a diluted acidic solution, 0.5% acid and 99.5% water. We inject that into the ore body. And the important part is we have a highly fractured and almost rubbleized ore body. It's like gravel, essentially. And really, Mother Nature has done this for us. We're not fracking ourselves. It's Mother Nature has essentially already fracked this. So we inject solution in, the solution travels, permeates out through the ore body, and gets sucked up through recovery wells. At that point, you have copper-bearing solution, and that the copper cathode sheets are recovered through a conventional electrowinning process on surface in a plant. So, as I said, it's quite exciting, and obviously the results that we've had on this through our production test facility were very positive and have really proved that we can make copper here at low cost. And also low, and as I mentioned, low environmental impact. There's very little surface disturbance here, a small footprint in terms of the site. We're not digging a hole in the ground. We don't have a tailings pond or waste rock or drilling and blasting like you might have at an open pit. So that leads to very low energy consumption in terms of electricity, carbon emissions. Carbon emissions are 83% lower here than at a conventional mine, and very little fresh water use as well, as we have everything we need on site. So these attributes are really getting a lot of attention, I think, in the US market from end users of copper. There's a lot of focus right now between, or a growing focus, I would say, in consumers and consumer-oriented businesses where they're tracking the carbon content of the metal that's in their products, and this type of production method really will play well into that economy in future years. So we're on a clear path here to production. We've got, as I said, 2017 we got the permits to build the test facility. Built that in 2018. Produced first copper from the test facility in 2019, and operated that for 18 months. So we produced over 1 million pounds of copper out of the test facility. That's LME grade A copper. And in December last year, we received the first of the 2 key permits that we need to move to commercial scale. So we received the Aquifer Protection Permit from the state of Arizona. And now we're just waiting for one final permit, which we expect here imminently in the next couple of months here. So that'll be a key catalyst for us when we get that final permit. Project financing, we're in a strong position there, obviously, with the copper prices. We were able to refinance our bond that we had in January this year. We upsized that. So between that, the increased proceeds from our bond and the copper prices well over $4, we can generate, as I said earlier, we can generate very good cash flows from Gibraltar at these levels. So we feel like we've got most of the project financing in place now to build out the commercial scale. And really well set up here to start construction later this year and be in first commercial production essentially 18 months later. So yeah, as I said, the economics here are really strong. When you look at CapEx intensity, we're just under $6,000 per ton of installed capacity, and that makes Florence, very attractive in terms of capital costs. A typical copper mine could be $15,000 to $20,000 a ton, and that just makes it very challenging. That's actually one of the reasons why not many mines are being built, because the capital costs are just so expensive to build them, and you need $4 or $5 copper price to justify the investment. Well, Florence is a bit different, given the economics, the capital cost, and the low operating cost. We can generate a good margin at any copper price here. So again, pretty excited about it, and it's going to be a great asset for us in the future years. Beyond Florence, we have 2 other projects in our pipeline, Yellowhead and New Prosperity. So in total, that gives us over 15 billion pounds or nearly 15 billion pounds of copper reserves. That's about 5 cents a pound of copper in reserves, and that's much lower metric than our peers, and much more reserves than all of our peers in the copper space. So we take a long-term view to building out our assets. We recognize it takes time. We acquired Gibraltar 20 years ago, Florence 8 years ago, and that's just coming on stream now. Yellowhead will come, we believe, potentially as our 3rd operation, and New Prosperity down the road as well. So it's a long-term game, but you need to have reserves in the ground to be in that game, and that's what we feel we have, and we just have to take a patient approach now to realize value from those reserves. So why invest in Taseko? I think that right now, when we look at our 2 key assets, Gibraltar and Florence, we believe there's a large gap in value between our market cap and the true intrinsic value of those assets, potentially a 500 million Canadian dollar gap. We think most of that value gap relates to the Florence project, and we expect that as we get the final permit and move that project through construction and into operation, that we're going to close that gap. And we think that that opportunity is a real going to be a real win for shareholders as we realize some of those catalysts over the next year. I think the importance of having a growth profile right now in copper is also quite unique. Many of our peers may have an operation or two, but they don't have an obvious way to grow the company. And I think at Florence, it gives us that. It gives us essentially 85% revenue growth by 2024. And at the same time, because of the cost profile, we're also improving our margins with that. At the same time, we're growing our revenues. So it's a great position to be in. We've got a strong cash position in ready to fund Florence, and we do have some debt on the balance sheet, but no maturities of that until 2026. So that's termed out, and nothing we have to deal with in the next few years. We've got a lot of leverage to the copper price, as I mentioned, and you can see that in our stock price. We've got a great pipeline of assets in low risk jurisdictions. And we think we have the management team and the proven history of our team to be able to build and create value from those assets. So just with one final slide just to finish on here, and as you may know, our company listed on the London Stock Exchange in November 2019, actually just a few months before the pandemic. We haven't had much of an opportunity with the health restrictions to get over there and meet investors, but it's something that we will be doing in future years to take full advantage of that LSE listing. But I think we certainly haven't been quiet since the listing. We've had a number of achievements and developments at Florence, at Yellowhead, with the refinancing of our notes, and obviously the improved financial results too. So we've performed very well versus when you benchmark us against any of the other London listed copper producers over that period of time, and believe we've got great potential ahead to continue our growth. So with that, Paul, I guess I'll wrap it up and I guess hand it back to you to coordinate if there's any questions.
Let me unmute myself. Thank you very much, Stuart. That was fascinating, and there was quite a lot there which was new to me. So I'm going to ask you some of the questions. There are some questions people have asked, but I mean, as you said, the Florence mine looks very different to the typical open pit mine that that we've seen as in Gibraltar and Bingham Canyon, places like that. They're the pictures we're familiar with. I mean, is this your own technology? Is it technology that is tried and tested in other places? And I guess my bigger question is does that sort of technology open up more copper resource around the world to exploitation than is currently online? I mean, is it sort of game-changing technology?
Yeah, I would say it's not necessarily new technology, but it's maybe a new application of existing technology. What we've seen in mining is in-situ mining has actually been used primarily in uranium mining for many years. I think even today it accounts for 40 to 50% of global uranium production, which is mined this way. We haven't seen it used much in copper mining. And the reason for that is typically in copper it's hard rock mining, right? You're drilling, it's bedrock. You're drilling and blasting that ore and then having to crush it and mill it. But at Florence, we really have a very unique geological situation that allows this mining method to work, and it goes back to that rubbleized ore. So Mother Nature has really given us a gift here that sets up perfectly for this type of low-cost mining. Whether we can take this mining method and apply it to other copper deposits, I'm not sure. I think there's a few around the world that we know of, but it's not a long list in copper anyway. There may be in other metals, but in copper mining, it's we'll see. You know, we're focused on Florence, but hey, maybe if we get this one up and running, there may be other opportunities for us. But yeah, it's a unique situation for sure.
It must also be much easier just looking at the pictures. You know, 90% of all the copper mines I ever see seem to be in pretty mountainous territory, whereas the Arizona one looks on pretty flat territory, which presumably makes life much easier as well.
Yeah, it does. It's a very good location. You know, we're about an hour and a half from Phoenix. We're about halfway between Phoenix and Tucson, in the desert, and it's located near a small town, near the town of Florence. Um, and yeah, it's a perfect, in our view, it's a perfect spot for this type of operation, a light industrial operation. We've got a gravel quarry next door to us. We've got actually one of the big industries in the town of Florence is prisons. They've got five state and federal penitentiaries, and that's become the big employer in the town. So we're going to offer an opportunity to the local economy there to diversify itself a bit and really bring you know, a positive development to the region. So again, pretty excited about it.
Well, that brings me on to one of the questions that one of our viewers, anonymous attendee, has asked, which is that you've mentioned the relatively small number of employees at Gibraltar compared to a similarly sized mine in South America. How many employees will Florence have when it's in production?
We'll have about roughly 150 when we reach full scale production. So yeah, relative to Gibraltar, it's not as labor intensive, I guess. But yeah, that's essentially, and there might be a few contractors on top of that as well. But yeah, something in that range.
And I mean, is there any particular, you know, are those people going to be capable of being easily found within the area, or I suppose, you know, in America, people are much more relaxed about moving to new places for good jobs, aren't they? But you don't see any problem in getting those roles filled.
No, we don't. You know, it's actually, again, kind of goes to the jurisdiction that we're operating in. I mean, Arizona is a real, you know, has a long history in copper mining, and we're really in that kind of copper belt that runs, you know, from east of Phoenix down towards Tucson. There's historical copper mines. There's current operating mines in the region. There's a smelter not too far away. So we're really in the zip code, I guess, of mining, as they would say in the U.S. Lots of access to contractors, consultants, and labor, you know, and people. So yeah, it's from that perspective, we've and again got all the infrastructure as well. So yeah, it's a good neighborhood to be in. You know, it's very different. That's one of the challenges that you see when you look at some of these other big projects around the world, where, as you say, they're up in the mountains, they have infrastructure challenges, they have uncertain, you know, royalty regimes and things like that, and you know, operating in those stable jurisdictions is our approach, is what we prefer, and we think there is great advantages to that.
Yes, well, I mean, for as long as I've been investing, there have been some very big projects in places like, you know, Ecuador, which seem to get bigger and bigger, but they never seem to get closer to happening. So, you know, that's the thing. I think, you know, you want to take things in bite-sized chunks in places where you know you can execute, really.
Yeah.
What kind of expertise do you need for Florence as opposed to a conventional mine?
Yeah, it's, you know, you've got to have the right people in place that know how to drill and operate a well field, essentially. And some of those skills come from other industries, come from uranium mining, as I mentioned, or come from oil and gas. Our project manager that we have down there, Brent Berg, he had a long history with Cameco in the operating their in-situ mines in the U.S. So you know, he's leading our efforts down there. We've got a strong technical team. and the consultants as well, and you know that support that. So we think we've staffed up the team quite well, and also the experience I think that we've even gained ourselves through operating the test facility. So we built and operated 22 production wells, and you know those were successful to show that we could do this mining method efficiently, but it was also a learning opportunity for our team, and you know we were able to learn, and some of the lessons learned are going to really assist us as we move into an expansion phase here.
Well, you know, again, when I was, you know, when you think of Arizona, the one thing you think of, it's pretty dry, and obviously polluting aquifers is one of the biggest concerns that people have in North America. And the fact that you've got people coming from the uranium business as well suggests to me that this technology must be pretty good at avoiding environmental pollution, because the one thing that isn't going to happen is you're not going to have people spilling uranium byproducts everywhere. So, I mean, you must be pretty confident on the environmental side with the Florence project.
Yeah, absolutely. And again, you know, one of the things that we've shown in the through operating the test is that we can control the flow of solutions inside the ore body, and that's one of the great technological advances that we've had in the world over the last 15 to 20 years, is that well field technology. So through hydraulic pressure and hydraulic control, we can keep the mining solutions contained in the mining area and not allow any flow outwards. We've got around our well field, we'll have perimeters of observation and monitoring wells, and those wells are tested and monitored, you know, daily and weekly and monthly. So it's a very rigorous compliance. It's very heavily regulated by the EPA and the state ADEQ. So yeah, but you know, we've shown we can do it. We've got the confidence of the regulators, and we're ready to move to full scale.
And I guess, well, that brings us on to one of the other questions. What do you see as the key risks in developing the Florence project?
You know, we think that we've, you know, I mean, obviously going back 10 years, there were questions about whether we could get the permits for this type of operation and whether we could operate it successfully. We think that, you know, through the work we've done since 2014, that we've really addressed the key risks. We got the permit to run the test facility. We got the amended permit to run the commercial facility from the state. We've shown that it works technologically. So, you know, so we feel we've done as much as we can to de-risk this. Obviously, when you start up a new operation, there'll always be, you know, there'll always be little hiccups along the way when you're ramping up something to 85 million pounds of production. We don't expect to zoom right to 85 million in the first month or two. It'll take a little bit of time to ramp up. You know, but that's probably our biggest area, is just that ramp up, and we'll focus on that when we get going in 2023.
And well, yeah, and obviously the low cost nature of the mine means that, you know, the cost of copper isn't as big a concern as it would be to someone that was, you know, a higher cost producer. The higher it is, the better, but it's not an existential threat to you, is it?
No, that's right. There's lots of margin here. There's lots of buffer in our economics for sure. Yeah.
So are you free to give any insights into your bond, which you said was refinanced earlier this year, and sort of what sort of rates you're having to pay on that? Is that something that you want to talk about or can talk about? Is it sort of expensive borrowing or pretty cheap?
Yeah, no, it's a publicly traded bond, actually. We originally issued a bond in 2011, actually, and we used those proceeds to assist to finance our Gibraltar expansion activities. And then we got to 2017 and refinanced that. But in the latest in the latest transaction was in January of this year. We refinanced and also upsized the bond. So we took it from a $250 million bond to a $400 million bond. So that extra, net of fees, that extra kind of 140 million that we raised, we've earmarked that for Florence development. The cost of that is it bears interest at 7%, 7% annual coupon. We pay that semi-annually. And it'll mature with a bullet payment in 2026, January or February 2026. It was a five-year note, and I think it's traded well since we issued it. I think it's trading over par now. So it's been a good source of financing for us. It's not something that, we paid probably a little bit more than we would with a conventional bank financing, but we like the flexibility that it gives us. We don't have covenants and things like that to comply with.
And so that gives you everything you need to bring Florence into production now, does it, or will you need to raise a little bit more?
We've got most of it with that bond. We're generating good cash flow from Gibraltar this year as well, which will supplement that. And so we'll see how copper prices go in 2022. We may do a small, we may do a small financing. It's not, but it'll depend on how the copper prices look over the next year or so. We want to make sure that the balance sheet is in solid shape, to bring on a new operation. We don't want that to be an uncertainty.
No, and I guess it leads to one of the other questions here, which is, if you did decide to bring in a partner at Florence, what would you do with the additional cash on hand that such a transaction would bring?
Yeah, that's we have talked quite openly about potentially selling a minority stake in the Florence project. I think if you went back probably a year ago, we were quite actively looking at that. I think with the improved copper market now that we've realized that we don't have to do that, but we can fund this and own it 100%. So that's our plan at the current time. We're still open to selling a minority stake if we get an attractive offer in terms of valuation, but we don't think it's essential at this time. If we did complete a transaction, I guess that's the kind of the hypothetical in the question. And if we had excess cash flow, we could look at reducing debt. We could look at potentially a small dividend. But that'll be a good problem to have if we have another year of strong copper prices. Right now, we don't see that imminently in the next 6 to 9 months. But again, if we get that transaction, that could change.
Now you're based in North America, so you probably don't fully appreciate how obsessed so many UK investors are with dividends. Is that a priority to you, or would you be more focused if you've got excess cash flow on, building up production, maybe expediting Yellowhead? How does capital growth and paying dividends balance out in terms of priorities for you?
No, even though we're based in North America, we're well aware of that preference in the UK. We've had enough conversations over there to understand that. I think the way we see it is really the focus for us is getting Florence built and getting it ramped up. And when we're in that position, we're going to be a very different company, in terms of our EBITDA generation and the cash flows that we're generating. At that time, I see there will be a period where we might want to just pay back some debt for a period of time, because $400 million US is probably a little bit more than we'd like to carry. So we would probably look to reduce debt, but then beyond that, absolutely, dividends are very much a possibility here. I think, if we look to the future, we've got a Yellowhead project as well, which could come, and that could be shovel ready in 25 or 26, but we'll see how that goes. But dividends are very much something that we're thinking about, but I still see it at this stage, given the work we've got to do at Florence, that they're kind of likely 2 or 3 years away.
So just to go back to Florence, I may have missed it during your presentation that we're just accustomed to thinking in terms of grades, which is presumably more relevant in a sense for if you're actually digging out the hard rock. What are the sort of grades in Florence, or isn't it relevant when you're using this in situ type mining? Is it of less relevance to the overall calculation?
Yeah, I mean, I think it's relevant. It's still a reasonable grade. We've got, I think, 0.36 or 0.37 copper at Florence, and so it's a higher grade certainly than what we're mining at Gibraltar. But with this mining method, yeah, it's just a unique way. We expect to recover about 70% of that through our leaching. And yeah, so those are the assumptions that we're going in with. It's a well-defined ore body. It's been drilled extensively in the 80s and 90s, and so there's good understanding of the copper that's there.
But then, when you're done there, do you just literally just take down the buildings and go away, and it's as if nothing ever happened? I mean, visually, I'm thinking in terms of the environmental impact.
Yeah, that's right. Yeah, you just cap. You can cap. Well, the way you reclaim it first is after the leaching is completed. We run through in each block of ore. We run through a kind of a 1 or 2 year what we call rinsing process, where we run initially water and then some sodium bicarbonate through, and that combination essentially restores the aquifer to pre-mining conditions, and then we cap the wells, remove all the piping off of surface, take away our plant, and it's really like we were never there. You could make a golf course or a park on top of that ore body. So yeah, it'll be low impact, and we'll be there for 20 years, and then the land can be returned for another purpose.
Well, that's amazing, isn't it? Yeah. I guess one last question then that I've got is just in relation to Yellowhead. Then obviously you're talking about possibly being shovel ready in 25, 26. So is the permitting going to be different? Is it different in the north of the border compared to the sort of things that we're more familiar with possibly in America? And do you see any permitting issues? Because presumably it's going to be similar to Gibraltar with lots of lakes, lots of water around, forested rather than the Arizona desert. Does that provide different challenges or ones that you're very familiar with dealing with?
Yeah, it's challenging as well to permit a new project in BC. I think that there's definitely community considerations everywhere you go in Canada, and there are First Nations considerations as well. Indigenous communities have to be respected and have to be a part of the plan as well, and they have to see benefits coming from these mines. So that's a process to go through to show the economic benefits that can come, and essentially convince communities that the benefits outweigh any environmental impact. So that takes time, and I think we see it as a 2 to 3 year process here at Yellowhead to go through that permitting work, including the community engagement, community consultations. So I misspoke when I said 2025 shovel ready. I think it could be shovel ready in 2 or 3 years, and potentially in production by 2025. No, that permitting work is critical. And that, as I said, I don't think in the current world we live in, it's not easy to permit a mine anywhere in the world. You've got to address the environmental concerns and address the community benefit. So that's what we're focused on right now.
And I guess in terms of financing as well, you want it to tie into where you are, your balance sheet in terms of how Florence is progressing and what your debt is at that time. It needs to all tie together, doesn't it?
It does, yeah. And Yellowhead we recognize will be a bigger capital requirement as well. It'll be probably $1 billion plus of capex. But when we have Florence and Gibraltar running, we can be generating several $100 million of annual EBITDA. And suddenly $1 billion capital project, particularly if we take that on with a JV partner, it can be very manageable for us at that time. So that would give us another kind of leg up in our growth profile, and potentially with the 3 mines operating, we'd be one of the largest copper producers in North America. So, but we'll see. As I said, we've got some work to do over the next couple of years on permitting that, and but meanwhile, let's get Florence up and running.
Great. Now, I think pretty much the final question is one that you alluded to, that you've had trouble with, but when do you think you will be able to make it over to London again? Obviously, you've got a keen fan on here who probably been to one of your presentations in the flesh before.
Yeah. We'd like to get over there in the fall, certainly. We're keeping an eye on the travel rules. It seems to be opening up here in Canada. I think got my second vaccination coming up here in the next few weeks. So yeah, we're anxious to get back on the road again, and meet face to face with people. Zoom and Teams are great, but it's good to be face to face as well. So we're looking forward to that. Hopefully in the early fall.
Excellent. Now, I'm just going to throw something in which I'd welcome your views on. At least it may be connected with the fact that you've not been able to travel to the UK as much as you would like, but Taseko has a listing on it's obviously got a listing on the LSE, on London stock market. It's also, is it on the Canadian one? Is it on the TSX or on the US?
Actually, all 3: Toronto, New York, and London. Yeah.
Okay. I mean, often, if anyone was minded to invest on the basis of what they've heard today and their own research, often it seems that liquidity is better in your markets than ours at the moment. I mean, so that's just something you don't need to have a view on. You may or may not have a view on that, but it's just something I wanted listeners just to just think about how if they want to invest, which market might be the best to do so.
Yeah, it's you're right. I think there's probably most of our liquidity right now is coming out of the New York exchange, the New York listing. We're trying to obviously increase our profile in the UK. I think a big part of us listing in London was to get access to new markets, new institutional investors, and also the UK retail investor, which we know are active investors. So we're keen to increase our exposure in the UK. Part of that was obviously spending more time on the ground over there, which hasn't been easy over the last year, but we'll keep working on it in the coming years here. Certainly, we look at London and New York as two of the 2 global markets for mining finance, and those are the places we want to be. And I think also the fact we haven't really issued stock yet into the UK market. We haven't done an equity financing, and that's probably held back the liquidity as well in that market. But over time, we expect that to improve.
Yeah, no, well, it's no criticism of you. It's a problem that we do find sometimes in the UK market. Sometimes there isn't as much liquidity as you would hope, particularly if you get a company that isn't having to raise finance all the time, which in many ways is the mark of a strong company. We don't want to invest generally in companies that are issuing millions of shares to keep the lights on. But the flip side of it is that you sometimes don't have as much liquidity as you may hope for. But I think it's been a fantastic insight into the company. I think it's certainly going to have given everyone here lots to think about, and lots to go and look at themselves. So thank you very much for your time, Stuart. A really interesting prospect in a market that is clearly a bit of a hot sector at the moment, and possibly for the future. I think everyone's interested in copper. Everyone's got a view on what's going to happen. But as you say, it looks like it's in structural default, the amount being produced compared to the amount that's going to be required in order to meet the green changes we're going to have to make. So you look in a good position, and best of luck to you going forward.
Okay, yeah, thanks very much, Paul. And yeah, as I said, we're excited to be in the copper business, excited to be listed in London, and yeah, thanks for hosting us today. Appreciate it.
That's great. Cheers, Stuart.